Imagine a single bank in New York failing. On paper, it's just one institution, a line in a balance sheet somewhere. But in reality, that failure could ripple across continents in minutes. Flights delayed, businesses frozen, people unable to access their own money.
Cash.
Most of us sleep soundly,
happening.
unaware
Where
that
is
this
the money?
invisible thread of risk weaves through every bank, every
ruined.
transaction, every dollar. It sounds like a thriller, but this is reality, and it's called systemic risk, a problem banks have wrestled with for decades, often behind closed doors. The last decade has been unusually calm, but history shows us calm is temporary. Lehman Brothers. 2008. A single domino fell, and the world felt the quake. Banks are not just vaults for your money, they are the circulatory system of the economy. They lend, they invest, they borrow from each other. If one artery clogs, the entire body struggles, and that's the essence of systemic risk. The uncomfortable truth is that the system is designed to tolerate small shocks but could crumble under a large one, and no one really knows when that tipping point arrives. Banks are connected in ways most people never see. Picture a spider web, each bank a node. Loans, derivatives, deposits, they form threads. If one thread snaps, tension redistributes. Sometimes it holds, sometimes it doesn't. Banks also lend to each other overnight in massive sums, trillions in some countries. This interbank market keeps liquidity moving, but it's invisible to the public. One bank can be struggling, and others might not realize it until it's too late. Ironically, banks often trust each other more than they trust regulators. That confidence, or overconfidence, can be both a stabilizer and a ticking time bomb. Banks are not helpless, though. They have tools, capital buffers, liquidity reserves, stress tests. These are essentially shock absorbers. Regulators require banks to hold a percentage of their risk-weighted assets in reserve, a cushion for bad times. But buffers are often just enough, not generous. Too much capital slows growth, too little, and a misstep can turn a cushion into a cliff. A 2% shortfall on a $2 trillion balance sheet? That's $40 billion. One miscalculation can break the system. And then there are derivatives, contracts meant to transfer risk. In isolation, they work beautifully, but across a network of banks, they become a web of obligations. The very tools meant to manage risk can end up magnifying it. It gets murkier. Banks face more than ordinary market risk, they face contagion. If one bank fails, it doesn't just lose its own money. Margin calls are triggered, fire sales of assets depress prices, and panic spreads across other institutions. These are the hidden math problems rarely discussed: nonlinear risk, feedback loops, correlated exposures. During the 2008 crisis, banks held mortgage-backed securities tied to the same risky loans. One default wasn't isolated, it amplified across dozens of institutions simultaneously. This is systemic risk in action, the invisible amplifier hiding in plain sight. Ironically, in a system built on trust and transparency, complexity often hides risk instead of containing it. Regulators perform stress tests, simulating recessions, market crashes, or liquidity freezes. Banks must show they can survive. But stress tests rely on assumptions. They cannot model human panic, sudden loss of confidence, or the unknown unknowns. Markets rarely behave rationally. Remember 2008? Stress tests didn't predict Lehman Brothers' collapse because the system's hidden interconnections weren't fully understood. Stress tests are guides, not guarantees. Step back and the picture becomes larger. Systemic risk is not just a banking problem, it's an economic problem. When banks freeze, credit dries up. Companies cannot pay suppliers. Households cannot get loans. Global trade slows. Governments often act as backstops, bailouts, liquidity injections, central bank swap lines, but these are emergency patches, not solutions. Every intervention carries a moral hazard. Banks may take bigger risks, assuming someone will rescue them. The paradox is uncomfortable. The stronger the safety net, the more tempting risky behavior becomes. It's like building a taller trampoline. The higher you jump, the harder you can fall. So, what do we really know? Banks are fragile, interconnected, operating under a veneer of stability. Buffers, tools, stress tests, they exist, but none of it fully erases the risk of a global ripple. Systemic risk is invisible, mathematical, and indifferent. It waits quietly in the shadows, only becoming obvious when panic spreads faster than money can move. And here's the final twist: no one can predict when the next domino will fall. Not regulators, not CEOs, not even you. The question isn't if systemic risk will strike again, it's when, and whether we'll recognize the warning signs in time.